Good morning, traders. This is your Forex market commentary brought to you by Real ECN. Today is Monday, the 10th February 2014. Today's discussion, we're going to analyze and break down how the euro-dollar market reacted over last Friday's US non-farm payroll report. So, based on technical and fundamental bias, if you're trading the euro-dollar pair, I hope this commentary is insightful for you to formulating a successful trading strategy. So first in line, we're going to look at the technical front on the euro-dollar market. Having a look at this chart, an analysis of a collection of technical indicators on the hourly time interval on the euro-dollar market suggests a temporary bullish market sentiment and recommend short positions on the greenback. The hourly chart also established a short-term resistance at 1.3700 level, and Friday low also provides support at 1.3551 level. The euro-dollar pair continued to trade above the 200-day simple moving average. This trend action holds great significance as 200-day simple moving average contain more or less of 1 year's worth of trading data, and this forecasts long-term market sentiment, and currently the pairs are trading above the 200-day simple moving average, which is indicative of long-term bullish market sentiment outlook on the cross going forward. This bullish market sentiment is also supported by short-term simple moving averages as the euro-dollar pair opens today's Sydney trading session above the 10, 20, and 30-day simple moving averages, but below the 5-day simple moving averages. Nevertheless, collectively, this is indicative of a temporary buy recommendation on the technical front. So, closely looking at this chart here, the euro-dollar market break through the 1.3600 level, opening today's Sydney trading session, and this is really significant because this is what analysts had put on a forecast. If the price breaks through this level, we're going to see a bullish bias in the near term moving forward, and this was largely contributed to the disappointing US non-farm payroll and the rising concern that the Fed tapering conviction may be in jeopardy. So, having a look at the technical indicators, right here we have an hourly time interval for 10 technical indicators. So we're just going to focus on 2 and quickly move forward. So moving down, we have the CCI, which is Commodity Channel Index, a signal of buy or sell, and right now it's ranging its really high level at 70.6865 with technical recommendation of a buy. Lastly, we're going to touch on the bull and bear power ratio is in positive territory with price reading of 0.0016 with technical recommendation of a buy. Overall, we have 7 buys, 1 sell, 2 neutral with the technical consensus of a buy. Now we're pulling up this chart, which is the S&P 500 chart. So the S&P 500 recently picked up after a big correction in late January. The S&P 500 is important because it's the gauge for risk appetite, and risk appetite is back. And as you can see that through the S&P 500 trend line picking up. And remember, the euro-dollar market is highly correlated to risk appetite, which is also correlated to the S&P 500. So this backed the bullish euro-dollar market moving forward if the S&P 500 continue to tick higher. So we're going to also look at the VIX, which is the volatility in the market. It's a measure of fear. Right now, the volatility index is falling since February, since the beginning of February, and the reason is because a reduction in volatility generally does provide the market with a catalyst to encourage participants to take on more risks. And more or less, it's largely due to the revised expectation of a deferred tapering based on the disappointing US non-farm payroll. With the fall in volatility, market participants are willing to take on more risk, and risk appetite is slowly coming back. So moving on to the fundamental fronts on the euro-dollar market, a mixed leading economic indicators have traders confused on the future of the direction of risk trade by which the euro-dollar pair are highly sensitive to. A consecutive miss in the US non-farm payroll number ticking at 113,000 jobs, short of market expectation of 185,000 reading, has the market raising concern over the prospect of the Fed's commitment towards tapering. However, it is also important to not discard the Fed's mandate, which focuses on the unemployment rate, which is in fact ticking lower to 6.6% from a December reading of 6.7%. The June FOMC meeting unemployment rate target was set at 6.5% before the Federal Open Market Committee will explore the option of possible rate hike discussion, while the time frame for ending QE was also set during mid-2014. This week, market-moving events coming out of Washington, D.C. that has captivated traders' attention is Janet Yellen's testimony on Tuesday. Federal Reserve chairmanship transition is always a volatile time for the market, as markets tend to require more time to become accustomed to Janet Yellen's monetary viewpoint, especially towards tapering. Over in the Eurozone, the Euro bullish momentum was carried forward into this week's trading session on disappointing U.S. non-farm payroll number, coupled with the ECB backing away from pursuing a further accommodative easing policy. However, the floor, Eurozone fundamental, and disappointing leading economic indicators all raises concerns that the EU may possibly face a deflationary, stagnated economy like that of Japan. This viewpoint was supported by a weaker than expected core year-on-year CPI reading, sluggishly growing at 0.7% prior to last week's ECB meeting. Many market participants are concerned and begin pricing in ahead of the meeting that the ECB will lower main refinancing rate by another 15 basis points to 0.1%. When Draghi failed to signal stronger dovish undertone, this have traders revised their bearish euro dollar market outlook. So last Friday's conflict of interest between the ECB and the German Constitutional Court over the ECB's bond buying program had the market fearing the future of Draghi's easing program, having reassured the market that he would do whatever it takes, unquote, to stabilize borrowing costs of the Eurozone member by pumping in excessive liquidity into the market through its bond buying program. The Germans are determined to fight against the ECB unsterilized bond buying program, and remarkably, this action alone has investors upgrading the euro bullish bias for 2014, as the belief still stands that this can cap near-term ECB power to expand its balance sheet. This week, market-moving data coming out from the Eurozone are fourth quarter GDP number for Germany as well as broader EU. Traders are watching this closely as it provides any indication to whether Draghi's recent belief in the ECB prospect in resuming growth is sustainable. So to wrap this up, it is important to note that the golden rule of trading is to judge whether both the fundamental and technical bias are all lined up before executing a trade. So have a successful trade, everybody, and thank you for listening.